Julia, let's kick it off with you today because it's been a pretty good day for the market. We'll take the gains up about 0.7%. How do the volumes look as well?
Volume's pretty healthy, just above $4 billion being traded, but it was a case of good news being bad news for the Australian market. We saw some of the good gains that we had seen in the morning fizzle out when those job numbers came out, and it was all about those job numbers today. We saw a fantastic set of numbers. In fact, if we have a look at the last 6 months, 5 out of the last 6 months, we've seen gains of more than 15,000 jobs being added. And in fact, in half of those months, we've seen more than 37,000 jobs being added. So it's very hard to be negative on the job numbers at the moment. Unfortunately, the market translated that as a less likely chance that we will see a rate cut in May. So some of those high-yielding stocks did see sell-offs coming into the afternoon. Commonwealth Bank was up as much as 1.1% in the morning, but by the end of the session, up by 0.6%. One area to mention today were the oil stocks. We did see the energy sector doing well after oil prices did very well overnight. Woodside Petroleum, though, missing out on the party. Its AGM today, some very subdued comments coming out. But of course, Qantas being sold off with those higher oil prices, bad news for jet fuel. So Qantas is down by 2.4%, but otherwise the energy sector having a very good day.
I think Fortescue, obviously, watching it very closely today after those production numbers. It's up about 5.4% at the close today. What did you make of those production numbers? What did you take out of it, given the fact that we're watching that plunging iron ore price so closely?
Well, lots of positive news to come out of this Fortescue update today. The first is that they have been cutting costs aggressively, and they're looking at all-in costs around about that $39 a tonne level in the next financial year. So that's a massive positive in an environment where we are seeing iron ore prices around that $50 a tonne level. So not surprising that we did see Fortescue's share price rally. I think the next challenge for Fortescue is going to be refinancing of some of that debt. Back in March, they had to pull that $2.5 billion debt issue, not because they can't find funding, but because they weren't happy with the pricing. And I think this is what's happening in terms of the iron ore space. Investors don't want to investors aren't willing to pay a huge premium in terms of some of these iron ore miners and even energy companies, because they perceive these to be higher risks. So I guess in terms of trying to raise debt financing, it is much more difficult for those iron ore companies. But I think a lot of positive news to come out of Fortescue. They did confirm that their run rate is looking close to that 165 million tonnes an annum mark, and they're aiming for that. But altogether, I think Fortescue, some good news today. The stock up 5.4%, and all-in costs of around about $39 really does bring them a lot closer to the BHP, Rios and the Vales of the world.
But Julia, for the moment, Iluka Resources, this mineral sands player, losing ground today, off by about 7.9%, so quite a significant downfall. What did you make of this one? I must admit it has run quite far so far.
This is a demand story. I mean, the stock is up 37% over the last 3 months, so it's had a fantastic run in 2015. Unfortunately, the demand's just not there for zircon especially, and titanium dioxide has also been under pressure. So if we have a look at zircon, it's mainly used for tiles and ceramics. About 50% of the demand comes from China, and about 55% of the demand comes from tiles and ceramics. And we know how tough the building industry is doing over in China, so not surprising that zircon is under pressure. We did hear that the first quarter was very subdued. They have said they've seen a turnaround in April, but given the stocks rallied 37% over the last 3 months, investors were hoping for some good news. Also, in terms of titanium dioxide, we look at the major uses there. 50% of it is used in pigments for paints, 25% of it in plastic. So once again, that building industry in China is absolutely crucial. Despite the sell down, you know, Iluka is a very well managed company. It's got a strong balance sheet. It picks up assets at the right point in the cycle, value added assets, but unfortunately the demand's just not there at the moment, so we're just waiting for China to pick up. Absolutely, it's probably all about technology at the moment, and it's a fantastic deal for Nine shareholders. This is all about the dividend. It's a world that's yield hungry. Australia's yield hungry, and if we have a look at Nine, they're going to be increasing their dividend substantially. Now, Nine's payout ratio at the moment is 50 to 60%. They're going to be raising that to 80 to 100% in the next financial year, starting off from the interim dividend in FY16. This is a massive jump. It means that the dividend has the potential potential to double in terms of the payout ratio. So in a world where we are seeing interest rates falling, negative interest rates in a lot of the globe, I think we're going to continue to see Nine shares well supported off the back of this announcement. They have also said they're going to add to that $150 million buyback. But don't forget, the media landscape is changing very rapidly. And if we do see a change in media reform, especially of that 75% reach rule, then Nine could very much be in the driver's seat in picking up some of those regional assets that have been in focus for so long. So not surprising to see Nine up by 3.7% today. I think the shares will continue to perform well on anticipation that the dividend will increase quite substantially.
Perfect.